Hello and welcome to the Freight Flow Advisor Brief. This podcast is all about breaking down the freight market, analyzing the latest news, and breaking it down in terms that you can understand to help you make your freight decisions. We're currently in July and we're starting to see some earnings roll out. Last week, we saw a set of earnings released in both Union Pacific and CSX that we're going to cover today, as well as an agreement between Union Pacific and CN that may change the dynamics of the merger. So let's jump into it. Starting with UP. They had a solid quarter. They reported second quarter 2026 net income of about $2 billion, and that's up 6% year over year. They reported diluted earnings per share as coming in at $3.36, up 7%, and adjusted EPS was even stronger at $3.41. This shows that the underlying operations beats the headline number. Now, as always, we're going to break this down into plain English because what this means is they're moving freight at better margins than last year. Pricing power and network efficiency are offsetting the cost pressures. Cash generation is robust. Their investor deck shows billions in cash from operations over the first half of the year. This is a clear sign that Union Pacific is not in a cost-cutting survival mode. They're in a confident price and invest mode. So if you're negotiating rates, building rail versus truck scenarios, or thinking about long-term capacity, this kind of earnings profile usually translates into less desperation on price, more focus on the yield and mix, and continued investment in corridors that actually matter. Now, as we pivot to CSX, they just printed a very different but equally important story. Volume is coming back and they've raised guidance for the year. Here are the core numbers. Second quarter revenue was up about 10% or roughly $3.93 billion. Operating income was up 17% to around $1.5 billion. Earnings per share was up 23% to about 54 cents. Listen, those are aggressive growth numbers for a mature railroad. More importantly, CSX didn't just report a good quarter, they raised their outlook. They now expect full year revenue growth in the mid to single high digits. They expect an operating margin expansion of more than 350 basis points and free cash flow growth of more than 80%. That's a management team telling the market they see a sustained demand and believe they can convert it into cash at scale. When you look at this from a freight perspective, Eastern rail capacity is tightening relative to demand. CSX is positioning itself as a disciplined volume plus yield carrier. You should expect continued focus on service levels and pricing discipline on key corridors. For executives, investors, and even network planners, CSX is signaling that the recovery in rail volumes is not a one-quarter blip. It's a trend they're willing to commit guidance against. Now, when we put this together, Union Pacific is showing margin strength and steady growth, while CSX is leaning into volume growth and upgraded expectations. If you zoom out, earnings across Class 1 rail space this season have largely come in way better than expected, with multiple carriers beating EPS and revenue estimates. I think a lot of that is attributed to the tightening happening in trucking capacity. There's been a lot of enforcement within the last 18 months that has reduced the amount of capacity available within the market and really forced shippers to pivot their freight strategy to more rail-centric strategy. So just know that if you're a shipper, you're really walking into a rail market where carriers now have the confidence. You can expect a more structured pricing program. They'll be more selective about their discounts, and they're going to raise their level of expectation when it comes to fit in their volume profiles, dwell, and car utilization. The story here is not rail is struggling. The story is really rail is quietly rebuilding pricing power and strategic leverage while demand normalizes. Okay, now that we've covered Union Pacific and CSX, I want to get to the rail strategic chessboard, because that part, I think, will matter in the next 5 to 10 years. Union Pacific and CN have signed a binding memorandum of understanding that sets a framework for CN to secure competitive access in connection with the proposed UP-NS merger. Here's what I want you to understand about what just happened. CN really gains new access in the U.S. Midwest, including overhead rights between Tuscola, Illinois and East St. Louis, Illinois. CN gets the right to serve customers between St. Louis and Kansas City. And they gain a footprint in Kansas City with usage of Union Pacific's Neff Yard. CN also acquires Norfolk Southern's ownership interest in Kansas City Terminal Railway and the Terminal Railroad Association of St. Louis. In exchange, CN will not oppose the Union Pacific Norfolk Southern merger and will actively collaborate through the Surface Transportation Board process to implement this agreement. In simple terms, Union Pacific and Norfolk Southern are trying to merge, and CN had legitimate concerns. These concerns ranged from competition, gateways, and customer options. Rather than fight this thing out in an adversarial multi-year regulatory battle, they simply just cut a deal. CN gets real, tangible access and control in key terminals and corridors, and in return, they support the merger. Now, if you're watching this from the sidelines, here's what this truly signals to me. This merger is not a fantasy press release. Major counterparties are already negotiating the post-merger competitive landscape. Gateway protections and competitive access are being hardwired into side agreements, and they're not being left to chance, which means that this merger has real teeth and that there's a real possibility that it may go through. Listen, CN's footprint in the Midwest and Kansas City is going to grow, which could create new routing options and pricing dynamics on those lanes. If you move freight through St. Louis, Kansas City, or the broader Midwest corridors, your future rate structure and carrier mix will be shaped by this agreement. So I want to pause there briefly and talk about FreightFA.com because we're really turning all of this into actionable decisions. FreightFA.com looks at earnings, it looks at mergers and access rights, and helps you make better freight decisions. And I want to specifically talk about Freight Flow Advisor because if you're listening to this, you probably do one of three things. You either set the budgets, you negotiate, or you decide which mode to use in which lane. Think of Freight Flow Advisor as your 24/7 freight analyst. It sits on top of your TMS and decision layers. Here's what it does in plain language. You type in an origin, a destination, weight, and commodity, and it pulls a directional rate for you to benchmark with. And it does this across LTL, FTL, rail, and intermodal. It's going to tell you how those modes stack up on costs, transit time, handling, risks, and the carbon footprint. It converts those estimates into carrier-ready RFP packages. Think about lane templates, target rates, and structured scope. And this is all exportable into spreadsheets. This engine is built on the same kind of data we're discussing today. Class 1 earnings, AAR traffic, DAT, DOE, plus live carrier and authority data. If you're trying to decide, for example, how the UP&S merger or CN's new access in the Midwest could change your rail versus truck mix, you don't need a 50-page consultant report. You just head over to FreightFA.com, open our Freight Flow Advisor, and you start chatting away and let it become your consultant. Here's the best part. You get free daily usage, up to 10 quotes and 10 chats a day. Our Pro tier unlocks unlimited rates and our RFP tools. Our Desk tier adds scenario modeling and predictive capacity to test. So make sure you head over to FreightFA.com and try our Freight Flow Advisor. All right, let's get back to why this CN agreement matters for competition and for shippers. Specifically speaking, let's talk about the competition on the ground. When railroads merge, shippers worry about one thing, going from two choices to one on critical lanes. Now, CN's announcement explicitly focuses on preventing that outcome where it's commercially and operationally feasible. The agreement says CN will gain access to shipper facilities where Class 1 options would otherwise be reduced 2-to-1 or 3-to-2. That sounds technical, but it's really not. Here's a practical takeaway, if you will. If you're a shipper that currently has 2 Class 1 rail options, and this merger would take you down to 1, CN is really positioning itself to now be the second option. That preserves competition, which is another way of saying it preserves your ability to negotiate. CN acquiring Norfolk Southern's interest in Kansas City Terminal Railway and the Terminal Railroad Association of St. Louis is very notable because those terminals are more than dots on a map. They're actually choke points. They decide who can route, interchange, and serve customers efficiently. CN gaining in that stake gives them real operational leverage. And if I were to put it bluntly, CN agreed not to fight the merger because they got meaningful assets, access, and rights that keep them relevant in a post-merger landscape. So listen, if you're the one responsible for translating this into actual pricing modes and mode choices, this is exactly the type of environment that we've structured Freight FA for. Remember, it's a data-driven tool because strategic agreements, earnings calls, and merger filings don't automatically become smarter procurement. So that's it for today. If you've enjoyed this episode, please make sure to share it with fellow colleagues, the folks in logistics, and your supply chain executives. If you want more detailed breakdown, head over to substack.com and search the Freight FA Brief. We curate articles that provide deeper analysis for you to be able to make smarter freight decisions on a daily basis. While you're there, make sure you subscribe. Also, make sure to check us out on social media at the Freight Flow Advisor. We're on YouTube, LinkedIn, Facebook, and Instagram. You can also listen to this podcast on the platform of your choice, including Apple and Spotify. Until next time, this has been your Freight Flow Advisor Brief.